Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Well, good weekend, all. Ira Epstein with your agriculture update for this Friday, and we're now at the 20th of April, 2018, just getting on to 4 p.m. Central Daylight Time. As you can see, a down day in the grains. Well, it's a mixture. Number one, they had the pressure of a roaring dollar to the upside, and yes, that market came roaring right back today. Yields on the 10-year note went up nearly to 3%, 2.96%, and it's all starting to weigh on the market. What else? We're already at April 20th. You know, the planting for corn isn't going to be that far behind us. Another 4 or 5 weeks, and we're really into the harvest in South America, and we know an awful lot more about the crop. And the bullish news about the meal and beans, well, the next piece will be when actual harvests are done, not estimates, and you find out just how much they're missing or did they gain any of their crop back. And that's been, of course, the real big issue with the grain market, trying to figure that out. In the meat market today, we had the cattle on feed report. It came out neutral. So if you're looking for a big move up or down from it on Monday, it won't be off that report. It was just about on what the pre-report estimates came out at. Here's a monthly chart, an area chart of closes. This is the 18-week moving average of closes in red. The blue line represents what I've taken as the low number that it's had, the highest close at 1045, and you've turned down a little. The pattern, though, has been one where you've made higher lows, you can see that, and higher highs. So I say the market's in an up thrust. The bias is up because the market's over the 18-week average of closes. Before I get too far, I want to tell you, I'm going to be holding a webinar, and that webinar is going to end up being on this coming Tuesday. It is free, and I'll get to the details of it as I finish a lot of what I'm doing right now. But I don't want you to go away, because when you get into these, then you can question me, you can ask me to bring up charts, and I'll do my best to answer your questions. So let's go now, if we could, to the weekly area chart of closes, which is different. First of all, it's in a down thrust. I guess I've got that T crossed off there. But you can see how the market is broken down. The market is still in an up thrust because it's over the 18-week moving average of closes. And remember, all that this is are the closing prices on a week basis. They're not taking into account the high and low of the week, just the closing prices. So the market's lost some momentum right here. When we take a look at a weekly bar chart, each one of these bars represents a full week of trading. And now that the market's closed, you can see that for the week we lost 25.5 cents. I put onto each chart a study called a swing line. And what it does is it takes the current week, and via a formula that I wrote, it connects the previous week either to the prior week's high or low. And what I'm looking for is a pattern. And the pattern I like to see is, if you're in a downtrend, lower highs and lower lows. In an uptrend, higher highs and higher lows. What does it tell me? Right now we have a pattern of lower highs and certainly lower lows. That is bearish. The market negates that if you take out 1067.25, and if that were to be taken out, because the lows are under the market, you could end up with higher lows, higher highs, but you're not there. The bears will defend that number if they want to keep the trend in place. I then filter that with moving averages. Now, what you have here is the 18-week moving average of close in red and the 100-week in green. A couple of things. You had a crossover right here where you can see here's the 18-week average under the green. That's the red one. Then it crosses over right here. That was April 6th. The market then went up for another high. It didn't quite take out that high, and it has slipped back. Where do you think support will be if the market breaks? I would say this combination. Doesn't mean it has to stop there, but if you go back and you look at charts when you come up, often you'll come down in, like right here, you stopped on this week, then you challenged it again, and then you slip through. You'll see that as you rally back up, it's often you'll get that. Can it just go like this week did and jump it? It could, but more times than not, it's going to stop at these numbers. That's what charting's about, trying to play the probability of what's more normal, and then you take it from there. So if the market were to slip back, I'm looking for that support. Where's the resistance? Well, it was seen back here. If you look at Bollinger Bands, to get a trend, you often come out of what we call sideways action. Do you see that? From here, you either get the market saying, it's made a top and it's coming down, or from sideways action going up. Markets like to trend, but they spend more of their time not trending than trending. They're looking for it. This market had a breakout, and if it could stay up a little more over that, then you're looking for the market to continue. With that pattern, you'd had higher lows, higher highs. By the way, that was February 23rd. I don't want to give you an impression. It's a long time ago. You were staying over the Bollinger Band, and the idea of Bollinger Bands is only 5% of the time will you stay over or under the band. 95% of the time you'll stay within it. So when you get 3 weeks in a row over it, you're begging for a correction. And here comes the correction in the market. Now the question is, can it get back over it again? It starts breaking down. This is March 23rd, trying to come back up. Hits that support level of the combination of the 18 and the 100-day. If it goes up again, will it get to the Bollinger Band is what you're asking, and that was last week. And this week the answer is so far no. Support, I would expect, back right where it was. In momentum in the market, the negative here is momentum was going flat, and it's now turning down, as measured by the indicator, the oscillator actually called slow stochastics, and it is turning down. So here's what I say. You've got divergence. You have momentum turning down, you have the market over the key moving averages, and you've got lower highs and lower lows. You've got a mess on your hand on that chart. In the weekly soy meal, you're getting a bit of divergence here. Momentum is turning down. The pattern is still bullish. You have higher lows, higher highs. What would break that pattern? Taking out 360, 370. So until that's taken out, which is $10 from here, the bulls still have the bias going for them because they're over the key moving averages. They are fighting a downshift in the weekly momentum, and the trend is up. When you come to soybean oil, you have a market that is, number one, each time it has challenged recently the 18-day average, it has failed. Why should it change? Each time it's hit the Bollinger Band, it has found support. Therefore, if it hits it again, I'd look for more of that. And it has the most important element that's got locked in downside momentum is the market is just saying under the 20 level, which is very oversold, but when it stays there, it can reverse course and lock in a change. And when that occurs, often prices, if they try to rally, they get stymied. So the resistance, 12.16, support 30.84 in this chart. In the corn market, like the soybeans, you're getting divergence. You're getting momentum down. Now, if you believe that momentum leads price, which I do, then this is a scary situation. You do have a pattern of higher lows, higher highs, but you had hit the objectives, you came down, couldn't quite get to these averages, went back up to challenge the upper Bollinger Band. Again, that algorithm designed to keep the market going down, and you're backing off. The market is not bearish. It's got divergence. There's a difference. The trend is up. The bias is up because you're over these averages, but you're losing that momentum. And I think you're seeing that this week when you lost a dime in price. In the wheat market, you have a different type of market. On the weekly chart, you have the trend down. You have lower highs and a lower low. It's countered by the fact that the market's over these averages. The two flatten each other out, and momentum is sideways to lower. I'm still looking to see if the market finds support down at 452.25, but the pattern is not friendly. When you look at cocoa, everything's still bullish. Momentum, similar to what we were talking about when you get these locked-in readings, bullish. Pattern higher lows, higher highs. You keep running on that Bollinger Band. The market this week closed at 27.49, not able to close over the high that it made. It got to 28.54. It backed off from there, but still a very powerful market. And where did this all begin? I want you to again look at this because it's so important. Do you see this sideways action? It's a precursor to some event going to happen. So the trick is trying to figure out what that is. In the sugar market, everything is bearish. You've got lower highs, lower lows. You keep running the lower Bollinger Band. You came out of that sideways action, and momentum is locked in. There's nothing bullish on this chart. Coffee market, same thing. Now, if momentum gets over 20, the red line, which it didn't do, then maybe you're going to get a bit of a turn in the market back towards that 18-day average. Could it go further? Of course. But I'm just, as a chartist, giving you what I'm seeing. You still have to get over the 119.40 level in order to negate the downtrend. I say the bias is down. You're under the 18-day average of closes. Momentum is still bearish. And the market's got a pattern of lower highs, lower lows. Cotton is bullish. And it went up this week now. Look at this rally. The high was 85.63. 86.45 is the upper Bollinger Band, the resistance point. Momentum is pointing up. The trend is up. Now, you did something this week. You have what's called an outside week up. When you have an outside week up, one of the tools I use is saying that the low of this week should not be taken out for 2 weeks. If it is, I will call this a bull trap as a chartist, and I will look for prices to make an attack of the closest moving average, which in this case is the 18-week moving average of closes. Until that occurs, all systems go. In the cattle market, you have traveled from the upper Bollinger Band and in a matter of 2 months gone to the lower band, coming back up. Now, in cattle, we've been looking at expansion of herds for a very long time. In this report, we saw the first contraction, but it was expected. What we're looking for is that barbecue season. There's good weather to start making a lot of demand in this market, and as you all know, we have had cold, snow. It has been one terrible spring for many of us. I know down south it's different. Kansas, it's different. They're having fires, drought conditions. I get it. But when you're in the Midwest, we are normally warmer than 30s, and it's been pretty terrible with this amount of snow yet. If it rallies, I'd look for resistance back at the 18-week average, supports the 100. It is not trending. You have a higher high and lower low. You have the market saying momentum's coming up, but the bias is down since you're under the 18-week average of closes, and you can see how the hogs have just come screaming back up. This break was in large part created because of the tariff war between the U.S. and China. Remember all that talk about pork? They're going to ban that pork coming in, well, they're not banning it. They're putting a monster tax on it. Market seems to have gotten over that. But I talk about all this in my webinar, and it is an invitation only. So what we do is we email it. Now, I sent them out twice this week. If you didn't get one, obviously, or if you can't find it, you've been culled from our mailing list, or you just didn't get on it. How do you get about that and what's involved in the webinar? Let's first talk about what's involved, because it's all free. I'm going to bring up charts. Any charts that you tell me to bring up, any studies, I'll do my best to go through them with you and tell you what I know. If you haven't received the invite, you give us a call at this number. All you do is call. We will send you out the invites right away. And in that invite, you will have a password. You need that password to get in. No credit cards. There's none of that. It will take place this coming Tuesday. That's going to be the 24th of April at 1 p.m. Central Daylight Time. It lasts about 30 minutes to an hour, depending on how many questions we get. How much fun I'm having is really what it's going to boil down to. But you can bring your ETF symbols and questions. A chart's a chart to me. So we try to figure this stuff out, and we explain why. I hope to see you there. Give us a call. If we're not here on the weekend, don't worry. Leave your name and number. We're going to get back to you. I'm Ira Epstein. You have a great day.